take a look here. You can see this is Dick. Now we're not seeing the price action prior to this where we saw that big bear market, but you can see the market is just coming off the lows here, and Dix is setting up quite nicely in a classic VCP, gets the shakeout, and you can see the relative strength line. See, it's moving into new high ground. Even as the market is going lower, the stock is holding up, and because of that, it's getting a nice relative strength where it's picking up there. So that's one of the things that had me looking at that stock, is it was holding up quite nicely in a tough market, and that RS line was hitting a new high. Here's another one, looks a little similar. You see a lot of these look very similar. But it's like a fingerprint. You look at it from far away, they all look the same. You look real close, they've got these little nuances, but they all have VCP characteristics. That tightness on the right side and going through that ringing of the towel is so paramount that you stick to that, and you make sure that your discipline is that you only buy stocks that have these characteristics. So this comes out of this perfect little base here. Actually, it's a pretty good sized base. Tightens up on the right side right there with that last little tightening between 29 change and 28. Very tight, goes up 450% in just 28 months. Now take a look here. Look at the weekly. So these are going to look good on a weekly too. You don't want to start time fishing or trying to find the best chart, or backing into, okay, it looks good on this time frame, but it doesn't look good on this time frame. It should look good on all the time frames, particularly a weekly and a daily. So I don't even think O'Neill ever really looked at daily charts very much, right, Dave?
Yeah. No, he almost exclusively looked at weeklies. I had to show him dailies to show him how they were setting up, because the one thing good about weeklies is that it eliminates a bunch of noise. And because sometimes a stock will look like it's breaking down in the first few days of the week, only to come back by the end of the week. And so sometimes it pays to look at the bigger picture and concentrate on that than getting faked out on sometimes the shorter term timeframes.
Yeah. I always consult the weekly as well as the daily. So here's Borland again. You can see very tight here. I mean, look at this. There's almost no fluctuation whatsoever for 1, 2, 3, or 4 days. Then it comes out here, you get the follow through, and then you get another little pivot right here. So you get you can call this a low cheat right here, or cheat right here, and then you get the handle that forms, it drifts down. Really just classic textbook, 530%, 22 months. Another one here. This is one that I traded, Farmion, 270% in 6 months. Again, if you just get a piece of one of these moves, now let's just say you don't get that whole move, you get a quarter of that move. If you got 10% of the move, it's 27% in 6 months. That's 60-70% a year just in those two trades. ROI. L3 Communications. I actually bought this a couple times, but this was my first buy. Almost 300% in 43 months. This was Voya. Now, this didn't make a huge move, but a pretty nice little 71% move. The pattern is perfect, though. Perfect little cup with handle here. Nice little tight pivot comes out. A few days, tennis ball action. Shake Shack, again, coming out right here. Quick move up, 86% in 30 days. See, that's what I really like. I like these stocks that go up 30, 40, 50% in a month or two, because I can really roll that over on a swing basis. Let's see, what else? This is Shake Shack a little bit later. So you got one setup off the IPO right here, and then you got another setup that subsequent to that, and another trading opportunity where it went up 60% in 40 days. This is similar to how I traded Yahoo. It made that big 8,000% move. But I was buying, I'd buy it breaking out of a base. It would run up. I think the first time I actually took a double. One of the times I was up 100%. And then a couple other times I was up 40 or 50 or 60. And then there was one time I was up 30. And you compound all those moves. It's a really big number. So here's Alibaba. Again, look at this big base. See, VCP forming right there. You see how all the action starts after you complete the VCP. And when you come out, that's where all the action is happening. And in that stage 2 uptrend, that's where the excitement is. That's where you're getting the inertia. 94% in 10 months. And of course, Dave, you know this stock well, Ollie's Bargain. I think we talked about it earlier. I was buying it right here. Actually, I bought some. I think it was right here too, as it turned up right here, and then I added to it here. And Dave and I were actually, without unbeknownst to each other, we were buying it on the exact same day. And so we were buying it right here. Dave held it for a much bigger move than I did, but this went up 330% in 30 months. As a matter of fact, Dave came down to Myrtle Beach for the seminar for the Master Trader program that we were doing, and prior to it, the day or two before, he went to go see an Ollie's bargain because we had one in Myrtle Beach. Here's the weekly. Look at what a beautiful weekly. I mean, it's just absolutely picture perfect. It couldn't get any better. Just perfect, comes out of here just right. We talked about this before, where look at the PE ratio. Okay, so when this is coming out of this base here, that and even off the initial IPO and around the lows, we're up around, I don't know, 140 times earnings. And when it's coming out of this base, we're at somewhere around 100 times earnings. Now the stock makes this big move, right? Makes this big move. And look, after it makes a giant move, the PE is cut in half. So that's because the stock's earnings, the company's earnings, were growing at twice the rate that the stock was going. This is why a stock can keep going, because as the stock's going higher, you think it's getting more and more overvalued. No, not necessarily. It could be getting undervalued. If the earnings are growing fast enough, the stock could double, triple, quadruple, go up tenfold, and it's a better value than it was 5 times lower, depending on the earnings. That's why having those big earnings is so important. Body Central. This was one that I was around. You can see it's actually December is right here. It was around Christmas time, and I was in a mall with my wife, and I saw a Body Central, and I liked the merchandise, the way it was really colorful. It just seemed it attracted me so much to go in. And I don't know, when it comes to women's clothing, my wife is the expert there, but she thought it was really a great place, and she said, yeah, this is probably it's more youthful for a kid, but she says this is definitely, they got it together here. So right away I went and I looked to see if there was if it was public, and sure enough, it was setting up in a base. And I bought it as soon as it broke out, and I sold it right into this move right here. But it was a nice little quick rip. Michael's was another one. I was buying it here. IPO. This was Phillips. This is one actually that I was watching and went up over 100% in 6 months. I was watching this and had it on my list, and I did not buy it because I very often stay away from oil stocks. And this is one of the times where I stayed away from it, and the stock was right and I was wrong, as usual. But it came out of a perfect little pivot here. And look, 1, 2, 3, 4 to 5 days up. Really, this is probably up just a little bit, but really, really nice breakout action. Now, important thing to look at here, if you look at this Phillips 66, this is a weekly, and this is just going through the stage analysis. You come out here of your IPO, you go into stage 2, you make that big move. It goes from, I don't know, $30-$35 up to $75, $80. So, it's a good 100 and something percent. Now you go into that stage 3. See, it gets real volatile. Some people would look at this and think this is a cup with handle. Well, it does map out a cup with handle, and it does map out VCP characteristics, but it's too wide. It's very wide. It's loose. It's all over the place. And then, of course, even if you bought it here trying to come out, it didn't really even come out. It broke down. And now right here, now you're going into stage 4. So you should be long gone. So you can even see this maturation cycle sometimes in a relatively short time frame, where it doesn't have to take, years and years and years or decades. It can happen. The whole, 4 stages can happen in just a couple of years. LinkedIn. So this is one that, like we talked about earlier, and Dave was saying how sometimes they go IPO and they're all hyped up, and they just fail right off the hop. And this is the same thing that happened with Facebook. Yep. But you see, and I waited till way over here. I wasn't buying this stock. Now, here's really something interesting. Notice how I'm not buying the stock until it's at just about an all-time high. And you see, that's where the action happens. That's where this really, everything starts really taking off here. As a matter of fact, it broke out here, and then I was on CNBC. they asked me for one stock. They said, can you give us just one stock? And I thought about it. I said, okay, it just broken out and had this big move up. It was extended, but it was such a strong breakout that I knew institutions were really piling into it. LinkedIn was my one pick. I was on actually with Tyler Matheson. I think it was in 2013. And this stock went on to make a nice move there. Let's see, a few others. Pega, I bought this twice, once here and once here for trades. Here's a weekly of Shopify. You can see, you know, the IPO again rolled over, and then see, once it tightens up, that's where it's breaking out here. Just showing you a few of these examples.
Yeah, and Mark, one thing I've been doing while you've been going through these is that on my MarketSmith program, I've actually been going back, and on some of these that are still trading, you can go back and you can go to the day when these broke out and then actually really study in detail the breakout and the move subsequently going forward. And that's where you can really learn a lot when you take these examples and then, you know, put them up on MarketSmith and start studying them.
That's a great tool on MarketSmith where you can backdate the chart and then you can move forward day by day by day, and actually, as Dave said, you could live through it as if you were there trading it. So we're giving you hundreds of examples here. And these are, you know, these are great examples of real life situations that were actually traded at the time. So yeah, absolutely. Dave, as far as, you know, again, here, this is a good, looks like your porcupine. It's got a bunch of, you know, yeah. Dave has a tendency to come up with metaphors that they stick. For whatever reason, you come up with stuff that always sticks with me. I don't forget it. It's very visual.
Well, it looks like, I mean, every time it gets that same level, it spikes up and it comes back down, and then and it happens over and over again. When it finally gets through that, look what happens. It gets going.
And that is exactly my point of this chart, is that I want to show you that what we're looking for, this really illustrates what we're looking for here. So we want to see some demand off the lows. You see here, you have some good demand right here. And then it goes through the VCP and it tightens. And what I was pointing out earlier, when Dave says to, you know, draw a line across the highs there from the pivot and see where the majority of the action is. And you can see right here, all this price action is happening where it's stalling out at around the same level. So what your job is to find the spot at which this supply stops coming to market, or at least it appears that it stopped coming to market. We don't know for sure, but we can make a pretty good educated guess by looking at how the stock's trading on the right side. And if it quiets down and it gets tight and the volume comes down, we don't have the volume here, but if the volume comes in, that is that's the footprints of supply coming down and less supply coming to market. Now, once you come out of there and you clear that level, you've cleared that troublesome level, and that also gives you some assurance that supply has stopped coming to market, and now there's no more supply. It's getting through there. This is just simple supply demand dynamics. So if if there's only X amount of shares in the float, and there's more demand, and then you're going to have the stock's going to go up. If there's so many shares for sale but there's a lot more demand, if there's so much demand but there's more shares for sale, the stock's going to go down. It's no different. I mean, if we were to auction off, let's say, iPhones, or iPads, and I had a trunk full of them, and there was 100 of them in my trunk, and I said, hey, I got iPads for whatever, $1,000 a piece, or maybe I start off even lower because I have so many, and now people start buying those, and as the supply gets lower, they become more valuable. And the price, I could start raising the price. It very, very simple. And if you were to go and chart, if you were to go to an auction and look at the bidding and on anything, I'm talking like a car auction, anything, look at the bidding. We actually did this. There was a study that I did with a group. This is a long time ago, decades ago, where we studied auctions and certain types of anything that was an auction marketplace and charted the pricing. And we found that even auctions, the pricing was forming patterns, and it would have supply and demand. It would form BCPs. You'd have tight areas, and it would break out. It was really quite amazing. So this is just universal, universal. And the reason why I have to keep pounding this home with you is because at some point, you're going to have some, well, you might be right off the hop because you don't know what you're doing in the beginning. You're going to definitely have difficulty. I assure you that this is not going to be easy. And if it is, God help you, because then you're going to get sloppy and think it's too easy and probably have some real problems. But you're definitely going to run into trouble, and it's going to take a while to get this down. So you've got to have a really strong conviction in the strategy and in the reasoning behind it, the research behind it. That's, I guess, probably one of my secrets, I guess. And I'd say, Dave, working with O'Neill, and seeing his success and the organization and what he built from that, that probably had to, give you some confidence. If you didn't have the confidence in it yourself, you certainly saw the work that was done in the research. I don't know about you, but I was really a believer. Once I saw what this was all based on, with supply and demand and earnings and sales and how it really worked, and went back and saw that nothing changed for 100 years, I was sold. And then I took personal responsibility. If I didn't do good, I didn't say, oh, the strategy doesn't work. I just said, okay, well, I just got to get better at it. And that's what made me stick with it. How about you?
Yeah, well, I think you become a believer when you actually see it work in your own account. I mean, right. When it's like, if you haven't had a strategy, you haven't had a discipline, and you're just kind of here and there, and you're listening to tips and rumors, and then all of a sudden you get these set of rules and you enact them, and then they actually start working, and you see these stocks take off and go, you just go, oh my gosh, I've never experienced this. It's acting like it should. And you're sold on it. Because once you see that success and you can see the gains that you can accomplish, you never want to go back, because you can see that it can be so rewarding.
Yeah, and the timing nature of it, I think it feels to me like anybody who's ever played golf knows how great it feels to hit that ball nice and square and just hit a really great shot off the tee, or and really get all of it. It just feels so wonderful. And that I get that same feeling when I buy a stock and it just bang, it takes off and blasts off to the moon, and I got that timing just right. It's like hitting the golf club right on the screws, even though they don't have screws anymore. But,
but
that's dating me. That's dating myself on top of it. Someone can tell you about this and how it works and the whole thing, but it's when you do it yourself and you can feel that success and you can see your account gaining very, very quickly when you hit something exactly right. That's when it'll be very hard to shake that, and you're just going to want to do it more and more. Yeah. And when I saw, the compounding effect, that how quickly I can time a stock and even get even a 20% gain or 25% gain in a matter of days or months, I did the math. I said, wait a minute, if I get, 8 of these in 1 year, I put this amount of money into each of them. Holy cow, wait a minute, is that right? 250%. The numbers were just amazing. Okay, let's just say I do half of that, 125%, half of that, 70%, 75%. Holy cow, this is really something else, almost like it's too good to be true. Well, it's not too good to be true. It's going to be very difficult, and it's going to take a lot of work, but we're giving you a big head start here. So I'm going to wrap up. Also, I just want to back up for just a second, because Dave was talking about where I asked why we don't want to buy on the initial IPO. In this section, we started off with talking about this as a primary base, of course. So I want to sort of circle back and just also tell you that another reason that we don't want to buy on the IPO is that there's no price action. So if you're trying to do technical analysis, there is no technical analysis that can be done on one price bar. So if you want to look for the VCP, I mean, you could use intraday charts. That's one way. But again, I default to the daily charts. Right here, you can see on Burlington, you actually had a little VCP right here, and you broke out. You made a little bit of a move, but then it came in and it's all over the place. And now you got to wait for that base to form. So sometimes, you'll have an IPO base. It'll set up. It'll break out. And you'll get knocked out, and then it'll reset, and you'll get another base. You might get, over a course of a bull market or a secular move in a stock, you might get 5, 6, 7 bases. You'll definitely get a lot of opportunities. But this is the earliest. This is when we're trying to get on board the earliest that we can, subsequent to the initial IPO, primary base. Okay, so we're going to wrap this up, and we'll be back. And then we'll talk about the velocity play, and that's also going to be exciting. All right, bye bye.